Welcome, chapter 14, the last chapter of this book. Bonds and long-term notes. Okay, save the best for last, or so they say. Bottom line is we're looking at long-term debt here for this chapter, and that's exactly what our first slide talks about. We're looking to fund our operations, not necessarily its operations. Actually, we're looking for more capital projects. If we're using long-term debt to fund our operations, there might be a problem, actually, at least from operational standpoint, from the looking at it from the cash flow statements, operating activities. We want to finance things. We want to buy bigger buildings, land, other things like that. That's typically why we issue long-term debt. Bonds are a big one, right? There's all kinds of different bonds and stuff we can do, all right? Bonds are issued by the issuing corporation. It makes them have to pay the amount of money. Actually, I haven't had my microphone next to me today. I hope it doesn't impact it. Nobody's complained. Anyway, the stated amount is our principal, our par value, face value, or anything about it. And our periodic interest is going to be stated on the bond, all right? So what is a bond indenture? It is, bottom line, it's the agreement between the bondholder and the bond issuer to make sure that the money is paid and everything, all the terms are good to go. Okay. Bonds, types of bonds. First, you have debenture bonds. I'm not sure if I'm saying that right. Those are your basic bonds. They're not backed by anything. There are, I guess, some subordinate debentures. I've never actually even heard of those, but anyway, I think that's literally the only time in this presentation we're talking about it. Mortgage bonds are backed by real estate. That's the only reason why they're called mortgage at all. It's because they are backed by real estate. That's what a mortgage is a loan backed by real estate. Then you're going to have coupon bonds. Coupon bonds are bonds that actually flip a coupon to redeem your interest. And I'm not sure, with all respect to McGraw-Hill, that they do this anymore. I really don't. If they do, it's going to be digital. But it used to be that coupon bonds, I mean, I remember talking about this in college. The biggest thing about coupon bonds was anybody could clip those things, send them in, and get the interest. So not sure that's a good idea anymore these days. Maybe back in the 40s and 50s when people were not going to steal stuff as much. Maybe, I don't know, maybe they don't now. Maybe we just know about it more. Callable bonds are bonds that the issuing company can buy back before their scheduled maturity. There's usually rules with that, and you probably would want to know you're buying a callable bond, because if you're going to bank on that bond giving you money for the rest of your life, like you're in retirement or something, and all of a sudden you don't have it, that might kind of be a problem. I mean, you get your face value back, but maybe that wasn't what you wanted. Serial bonds, they are kind of like your normal mortgage debt, your installment notes. You're getting paid, you're paying back part of the bond in addition to the interest. And then convertible bonds can be converted to stock. Those are actually kind of interesting. So when we record the issuance of a bond, we're going to be looking at this from both the issuer, the company that is selling the bond, and the investor, the person or the entity buying the bonds. So when we issue a bond, we're debiting the cash of $700,000 in this case, and we're crediting the bonds payable. The person buying it is going to debit investment in bonds and credit the cash. In most cases, you're not selling your par value bonds at the exact same rate the market provides, because the market changes every day. So what's going to happen is your market or your interest rate, your stated rate, is going to be different than your market rate. If the stated rate is equal to the market rate, then the bond is going to be sold at face value. That's how you're reading the slide. If the stated rate is, the second one down, is less than the market rate, then the bond is sold at, second one down, discount. Same thing about if it's greater than the market rate, it's sold at a premium. Okay. Premiums and discounts. That's what we're going to be dealing with, focus on, and doing amortization schedules on it. You guys are going to love it. I know it. Determining the selling price is, we're going to take the present value of the principal payable at maturity and we're adding the present value of the periodic cash interest payments. We're going to discount it at the market. This is if we're selling it at a discount, I think is our first one we're looking at. And the interest payments will be the face value times the stated rate. We're going to get into all this. Don't fret. Bonds prices are typically stated in terms of a percentage of face amounts. So, for example, you'd say a price quoted at 98 means a $1,000 bond will be selling for 980. 101 is $1,010. Okay, what if we sell at a discount? In this case, we have Masterware Industries issues $700,000 of 12% bonds. The interest of $42,000 is payable semi-annually on June 30th and December 31st. The bonds mature in 3 years. The market yield for bonds of similar risk and maturity is 4%. The United Intergroup Inc. purchased the entire bond issue, planning to hold the bonds until maturity. So what we got to do is we got to find out what is the price of these bonds. The market rate is giving us 2% higher. So in order for us to match market, we got to discount these bonds in order to get investors to still buy our bonds. So we're going to get less cash as the issuing company, and we're going to be paying a higher interest rate. And this is another thing to think about when you're a manager issuing bonds. You got to have the risk of, hey, how much do we need to bring in for this bond issuance? If you say you need 700,000 and you just do a face value of 700,000, it issues at a discount, you're going to be hosed. Probably going to get fired. So you got to factor in a bit of play in there so that if the interest rate goes down or up, you'll be okay. Oh, sorry. So to calculate this, we're going to take the 42,000 and we're going to take the present value of an ordinary annuity, because that's 42,000 at 6 periods and 7%, because we're going to divide the market percent by 2 and multiply the number of years by 2 because of their semi-annual interest payments. So our present value interest amount is $200,195, and the principal amount of 700,000 is going to be discounted at the same 6 periods at 7% from the present value of a lump sum, and that's going to give us $666,633. That is how much we're going to get in cash. So our journal entry is going. Well, we don't have a journal entry yet, I guess. I'm sorry, I'm jumping the gun. It's just re-showing you the amount here. Because our stated rate is 6%, we're going to do 6% of the bonds for $42,000 each year, no matter what, and that's going to be the total amount of interest we pay. But it's not going to, those added all together are not going to equal the actual amount of the present value of the cash flows. So we're going to have to do some amortizing in order to make our interest expense match up with what it really is. So here's our journal entry. We're going to debit. So this is for the issuer Masterware. We're getting cash in $666,633. We're going to credit bonds payable for the full face amount, $700,000. The difference is a plug. In other words, we're going to take the 700,000 and subtract out the cash, and that amount is our discount that we're going to need to amortize over the life of this bond. Now the investor is going to debit the investment in bonds at 700,000. Credit the cash of the amount they've actually paid, and the amount that they have as the discount is going to be the same. I mean, they're basically the same numbers, just flipped, but the 33,367 is our discount for the issuer, or sorry, with the investor. So they're going to have that as something they're going to have to deal with. And that could go into the note. Okay. So here's our effective interest. This is how we calculate it. We take the outstanding balance, the real balance, the present value balance, the 666,633. Multiply that by the effective rate, what you're getting from the market, which is 7%, and that's our effective interest. It's 46,664. Then every interest payment we're going to make, well, at least at June 30th here, we're going to be debiting the interest expense, 46,664 at the effective rate. The cash amount is less than that. So we're going to pay the 42,000, which is the 6% stated rate. The difference is going to be how much we're going to take out of the discount on bonds payable account. And that's the act of amortizing it. You can see what the investor is going to do. It's the same thing, just opposite. Here's our amortization schedule. This is the important thing. So the difference, the increase in the balance or decrease in the balance or whatever you, however you want to look at it, okay, that is where we're going to be crediting the discount. Okay, they're trying to show this table in the amount that you can use it for either the investee or the investor. Bottom line is you're going to take the 7% and multiply it by the outstanding balance to get the effective rate. The cash interest is always going to be the same. And then the difference between the two will be the increase in, or the amount of discount, whether you're going to increase it or decrease it. It has both up there. So bottom line is you see that after those 6 periods, we get to a 33,367 balance in the discount. Well, that's exactly how much we calculated initially. Where is it? Yeah, I guess it's right here, huh? It was the difference. Yeah, it was the difference between the 666,633 and the 700,000. So that's what we're doing there. All right. You're going to want to know how to do these amortization schedules. I'm going to show you a premium here in a second, but that's for the discount. The premium is just the opposite direction. Just be aware of zero coupon bonds. They don't pay interest. However, we're going to learn a phrase that you're going to want to know. It's called substance over form. Zero coupon bonds, zero interest, anything that says, oh, it's zero, really isn't zero. You still have to act as though you're getting that percent, that interest. Okay. You can't just say, no, we're bucking the market system so we can not do this or that. And as you can read here on this slide, it basically says that the issuer still can deduct the tax interest expense, the interest expense for tax purposes, and the investors still have to record the revenue, even though they've got no cash for it. It's like, why even do a zero coupon bond? But it says here, those that are tax deferred or tax exempt status are the ones that usually do this because their taxes are either so low or whatever they can afford to have no money come in and still have the taxes or whatever. So, and here's your information on how to do this. Like I said, we're really not dealing with zero coupon bonds. These are literally the only 2 slides in this deck that goes over them. So now what happens if a bond is sold at a premium? Well, it means that we're selling it for an interest rate that's higher than the market. So we're doing 7% while the market's or excuse me, 6% while the market's doing 5%. All things are held the same. Well, now we're going to get more cash because all the investors want our higher interest. So they're going to pay more money for our face value of, or for our bonds. We're going to take the same present value interest, except now at 5% instead of the other. I think we had 7% last time. So now we're taking it at 5%. We're calculating that our interest is worth 213,000 and our principal is 522,000 for a total of 735,533. We journalize this journal entry, except this time instead of a debit to bonds discount, we're crediting bonds payable from the issuer standpoint. The investor will debit premium on bonds investment. And as we amortize this one, it's the same way. We're going to take the face value of the amount, which is 42,000, still the 6% of the 700,000 times, divided by 2. But now the outstanding balance is 5% times the amount, and that's how much our effective interest rate should be. So we're going to subtract those two, get our decrease in the balance or our premium reduction, and move down until we get to our outstanding balance in the bonds of 700,000, and our premium has been completely amortized. The idea behind this amortization of the discount and premium is to bring us back to where a $700,000 bond is what we issued and is what we're paying back. If you're interested in bond ratings, these are things you can look at. I'm not much of a bond guy myself, so I don't care. But as long as it's above S&P's BBB or Moody's BAA, you're dealing with pretty good investments. Anything below that's junk. Don't deal with C's and D's, guys. I mean, seriously, even CCCs and CAAs, you're throwing your money away probably. I wouldn't do that. All right, when financial statements are prepared between interest states, the bottom line is you're going to have accrued interest and a adjustment to your discount or premium depending on the circumstances. So we're looking at this situation. You can pause the video to read it. As we go to the next slide, we see that we're going to take whatever the calculation would have been for the full period and then just multiply it by the 4/6 in this case because we had fiscal years end on October. So we have June. So we have July, August, September, October. So that's 4 months out of 6. So you're just taking that fraction of it and calculating it that way. Another way would be to do is to base the effective interest on a monthly basis, which would be a little excessive, I think. I don't think it's necessarily against the rules, but it is not common. But you know how you have your mortgage payments and your car payments and all those other payments every month. You know, you could argue you could look at this from the standpoint of every month, but like I said, because bonds issue at semi-annually, you're probably not going to see anything like that. Okay, these are your adjusting entries when you accrue the interest, okay, or the discounts, you're accruing that. Straight line method. Now that was the effective interest method. This is the straight line method. As you can imagine, the straight line method, like straight line depreciation method comparing to the other methods, is way easier. All you're gonna do is take whatever the discount was and divide it by the number of periods, in this case 6, and that's what you're gonna discount the entire time. Fun fact or fun trivia, because of this and how easy the straight line method is, how many companies do you think probably use that method? My guess is probably a lot. But if you're going to take the CPA exam, which one of these questions you're going to see on the CPA exam? Probably the effective interest rate method. I'm just being honest. Guys, the CPA, I know I try not to talk too much about it because I don't ever want to teach based on the CPA exam. I really have tried not to because I hated when my teachers did it. But the fact remains, it's hard, but it's doable. Okay, if I can pass the thing, you know, you can pass. I'm not gonna say anybody can pass it. It is hard, but you can do this. You got this. If you ever want to talk about it, I'm more than happy to as well. Debt issue costs. So you're not just deciding to wake up one morning, issue these bonds or these notes or whatever, but in this case, bonds. When you have a bond issue, you're going to have these costs. Either it's going to be just issuing the bonds, you have issue costs, or if you go through an underwriter, you have underwriter fee. Bottom line is you have to roll this amount into your bonds. So if you're issuing those $700,000 bonds, now you're going to add to that discount or premium this amount in there that has to be accounted for. So basically, you're getting less cash than you might have otherwise, and you're going to discount the bond discount and the debt issue costs. Because remember, we got to have the matching principle satisfied. Those debt issue costs were not just a period cost. They were costs that are going to impact all 3 accounting periods or the 6 periods we're going to be paying this interest over. So we have to spread those debt issue costs just like the discount over the entire life of the bond. And you can imagine if these bonds were 30 years. I swear my teachers when I was in college always did 30-year bonds and we had to do the amortization schedule for 30 years. I wanted to scream. So here we go, is journal entry. Same thing, just you're rolling up the debt issue costs after you do the interest rate. Okay, long-term notes. You know, hopefully you know this. Long-term note is issued. The borrower, who's the issuer, gets a notes payable liability. The lender gets a notes receivable asset. We issue it for cash. It's just straight cash. 700,000 for cash. Credit notes payable, which is its face value. The lender debits the notes receivable, credits cash. At each of the 6 interest dates, this is in a situation where we're not paying off any of the mortgage. We're just or the note. We're just paying the interest. Every time we have an interest expense, 72,000, 72,000, 72,000. Then, or sorry, 42,000. Sorry, I don't know where I got 72. Then at maturity, you pay off the note amount and you're done. It's kind of like a bond. What if we exchange for an asset? Now we got run back to the present value of the note again. So we have to come up with how much we're actually paying for that asset. So we're going to calculate that we have that $666,633. That's our implicit rate of interest, or basically what we imply by this loan. It's not stated in the agreement, because when you exchange a note for that, I mean, it's just, here's 12%, we'll give you that. Is it really 12%? In this case, it's not, it's 7%. So we got that discount again. Okay. So in that sense, we're going to go ahead and do another journal entry here, recording the fact that we have the 42,000 interest. We're basically just running through this all over again. Okay. And you see it's the same journal entry, got the discount, except instead of cash now, it's the debit to the machinery. After that, we're going to be doing interest expense, crediting the notes payable discount, and then crediting cash for the interest payment. All pretty much the same thing. Here's your schedule. All right, moving on. Installment notes. This is something I actually prefer. I like the installment notes. But before we get into installment notes, how about I give you your last word for the semester? Yay. The word is portrait. Portrait. That word again is portrait. Portrait. Papa. Oscar, Romeo, Tango. Romeo, Alpha, India, Tango. Portrait. Portrait. Make sure you put that in the quiz. Okay. Installment notes. So let's say we get a loan, $666,633. Why did we get that? Who knows? Maybe because it's going to be our present value of $700,000. So we take that amount. What are we doing here? We're calculating the installment payment. What we want to do is we want to basically calculate how much money we got to pay yearly for this, or in this case, I'm sorry, not yearly. This is going to be semi-annually. So we're going to take $666,633 divided by what we get from table 1, which is that 6% at 6 periods at 7%. This is the present value of an annuity, because we're paying these installment payments. So we take that and divide that by 4.76654. We have an installment payment of $139,857. This should be familiar. You should be pretty familiar with how to do all this. Bottom line is you're going to follow the schedule, seeing what our cash is and our effective interest was that 7%. We increase that balance until or decrease it depending on your circumstances, until our outstanding balance is at 0. Okay, if we do it with machinery, again, it's the same thing. We're debiting machinery, crediting the notes payable. We still have to deal with interest expense and crediting interest expense, notes payable, and crediting the cash we're paying for the installment payments. But in this case, looks like we're not dealing with that. Not dealing with any kind of. Sorry, I'm going backward. Sorry, I was mixing that up. All right, I'm going forward again. Get us back to where we were. Okay, financial disclosures. We need to disclose either in the financial statements or the disclosure notes any of the fair value financial instruments we have. We need to identify all this information that you can see here. I'm not going to go through all that. You can pause and read each one of those, but bottom line is you cannot hide the stuff from your investors or your creditors. You've got to let them know. Okay, let's look at Microsoft. So Microsoft has maturities of long-term debt, including the current portion. So you can see they have $55 billion that are due over the course of from 2023 to 2027 and beyond, actually. So this is for decision makers. The bottom line is you have to determine what the risk and return trade-off is. You can't just excessively borrow money, because then that makes it to where you're not able to pay it back. Okay, because you're just going to run out of money and not going to have enough to pay it back. But then if you don't borrow any money, then you're footing the bill and you're not able to have funds in your equity that you might need to prevent other issues happening. So it really just depends. You got to look at your percentage. And there's all these kinds of calculations and non-financial situations you got to account for when determining this. What your financial leverage is. Here's a condensed financial statement for Coca-Cola and Pepsi. So these are two good companies to compare. I mean, they're almost identical if you look at them in the assets and then the liabilities, the shareholders' equity. I mean, they're just right there. Tells you, you know, I mean, look at current liabilities. Pepsi has a lot more current than Coca-Cola, and Pepsi has a lot less shareholder equity. But PepsiCo has a lot more property, plant, and equipment. I mean, you just got to look at this stuff and what's important to you. What's important to you as an investor? Here's your income statement. Look at Pepsi. They're selling more. But I mean, naturally, if they're selling more, their cost of goods sold is going to be higher. I'd like to see these in percentages, truthfully, but look at the net income. Pepsi's selling more, but they're making less money than Coke. That's interesting. That is really, really interesting. Okay. Debt to equity ratio, you should be familiar with this. You just take your debt divided by your equity. Total liabilities divided by shareholders' equity. PepsiCo is pretty good. Look at that. Liabilities to shareholders' equity, they're 4.3. That means they're good. I meant their risk is high. That's what I meant to say. Coca-Cola looks pretty solid. Rate of return on assets. PepsiCo's lower. Coca-Cola's higher. I'd go with Coca-Cola in that situation. Return on shareholder equity. Pepsi's bringing home the bacon, though, as far as a percentage. Even though Coca-Cola had more, PepsiCo has less shareholder equity and therefore is able to give more of the net income to their shareholders. What's important to you as an investor? Is it stability, return on assets and debt to equity ratio, or is it profitability? Having more money on your equity. Times interest earned. How many times you're earning that interest? Okay. Early extinguishing a debt. Sometimes you can, a company can extinguish their debt earlier. There's usually provisions for that. If a company wants to do that, they have a specified call price if they do that. They do call their debt. And so what we're going to do is we're going to take losses or gains on the early extinguishing debt. More 99% of the time it's going to be a loss. If you have an arrangement where you can have a gain on extinguishing your debt early, geez, man, that'd be, you're almost making money. I wonder if that's against the law. Just like selling a stock price lower than the par value is. I wonder if there's something like that. That's interesting. So anyway, bottom line is you got your call price, which is 685. You're going to have your payable, which was 700,000. You're going to debit and credit those. You have your discount on the bonds payable. So that should have been what your the book value left over, right? Sorry, not the book value. You're taking the amount of the bonds minus the book value, which is whatever you haven't discounted at this point. You're going to get rid of that, whatever the balance essentially is in that discount. And then the remaining amount, the difference to plug, is going to be a loss. Convertible bonds exchanged for shares of stock. Basically, you have these bonds that instead of having them paid off at the end, they can be converted to stock. That happens. Here's what you do when you issue them. You debit cash, credit the convertible bonds and the premium on bonds payable. This is your normal thing because they're being issued at 103. But then if we decide at some point to convert them to stock, we're just going to debit whatever's left in those categories that we haven't paid or whatever and credit the common stock. Hold on, I wanted to just check the dates on this. So at conversion, it says half the bonds are converted. Oh, half the bonds. So yeah, half of the stuff. So we had 103. So we're going to do 50, and really it's 1.5, I think. Since the premium was 3, the premium should be 1.5. When the conversion option is exercised, yeah, this is your journal entry. Oh, I didn't read that part. It says, I'm sorry, I went back. Half of the bonds are converted at the time and the remaining unamortized premium is 2 million. Okay, yeah, then it's one. It's not 1.5, it's one. Because we've amortized some of that. Okay, I was just confused by that really quick. So this is when the conversion option is exercised, putting it to common stock. And this is from the perspective of the person that bought the stock or bought the options, the bonds, and they're converted. So now they have an investment in common stock and they got rid of their investment in convertible bonds. Um, Conversions can be encouraged by voluntary or they make you do it whether you like it or not. Detachable stock purchase warrants. This is basically you got warrants attached, but you can go buy stock at either discounted or face value price. In this case, we sold bonds for 103 at 103. We had 20 warrants attached. $1,000 bond. How many did we sell? 100 million of 8% bonds at 103. So we're selling them at a premium. And then we had 20 detachable warrants. Shortly after issuance, the warrants were listed on the stock exchange at $3 per warrant. So we're going to take the $100 million bonds. I'm sorry, 100 million. I had to figure out, I remember how to calculate this. So how we're calculating the warrants is we're taking that $100 million, dividing it by each $1,000 bond to find out how many actual bonds we're issuing. In this case, it's 100,000 bonds. So you see here, I'm going to use the mouse to show you. $100 million. We issued $100 million bonds, each accompanying each $1,000 bond. So that means one bond is $1,000. Take this 100 million, divide it by 1,000, you're going to get 100,000 bonds, what we issued. And each one of those had 20 warrants on each bond. So we're going to take that $100,000 bonds times 20 warrants at $3 each, and we're going to get $6 million. The cash we got was at premium at 103, so we took 100 million times 1.03, which is 103,000. Pretty easy to do. 103 million, sorry. And then the bonds payable were $100,000 or $1,000 bonds at 1,000 at 100,000. So that's just $100 million bonds. So the difference is the discount. We sold them at a discount. That's curious. Because of those warrants, we're selling at a discount. Cool. All right, when we exercise the warrants, it says assume one half of the warrants are exercised. So one half of those warrants were 6 is 3. So $3 million worth of warrants are exercised. So I'm going back again. $3 million of warrants. Did it tell us the amount? 1 million shares are issued for one warrant each plus the exercise price of 20. Okay, that's where I got the 1 million. I was confused where they got that. Take the cash, 1 million times the $25 that the people are exercising and paying, and you get $25 million. Well, we got to get rid of the equity. I'm going backwards to the stock warrants, equity stock warrants. We got to reduce from 6 to 3 by debiting $3 million. And the rest of it's going to be the common stock. The common stock's going to be 28 million. I'm looking for common stock to see if it said a par value. Didn't give us a par value, because if there was a par value, you would debit the par value for the common stock for the par value, and the additional amount would be additional paid in capital for the common. I was just curious, they didn't have a par value. So I mean, you could have a real big like problem where it covers a ton of stuff with just one situation like this, but they chose to keep it simple, and that's fine. Okay, liabilities at fair value. You can hold some of them at fair value if you want. Some can, some can't. Some are required, some are not. Just know that that's an option or an ability. Okay, for liabilities. Reporting changes in fair value. Okay, we're gonna put the changes in the other comprehensive income section. short-term liabilities would more likely want to be put in the fair value because they have the I don't know, they're the most common. Plus, it's also matters on like if it's the investment anyway, on how long you plan to hold. If you're holding it until maturity, then you gotta amortize it instead of holding it fair value. The changes in fair value. Okay, so you're reporting it at fair value here. You read this problem. That's fine. You can do that. So fair value rises. You're going to show you the debit to the loss on bonds payable, credit the fair value adjustment. And the new book value of the bonds is now at the fair value. Yeah. So if the interest rate declines alone created a $20,000 increase in fair value. Yeah, think about it. If the fair value, I'm sorry, if interests change in the market, it might make your bonds more attractive or less attractive. And that's just kind of how you have to figure if you got a gain or loss or, unrealized or not. Loss on a bonds payable could go to either net income or other comprehensive income, depending on the nature of the debt and where you put it. Reporting changes in fair value. I think we beat this dog. Let's move on. So yeah, so the big thing here on this slide is just you have to when you choose it, you kind of stuck with it. You can't bounce between the two to make whichever is favorable for you. So just choose wisely, I guess. Anyway, guys, that's it. Chapter 14. Yeah, that's right. I wish you guys the very best. Good luck on everything. And I don't know that we'll see you in another video. So you guys take care and have a good one. Take care.